Well, it certainly confirms what would be our expectation that the US is heading into a recession. But contrary to what the market has been doing so far, we think that further deterioration in the data could be actually supportive for the currency, if only because it's going to continue to feel market uncertainty, could feel risk aversion. And this is where the dollar's role as a safe haven could shine through again. What's also quite important, I think, is the fact that not all negatives are in the price, in the sense that the markets are already expecting the Fed to ease quite aggressively in the second half of the year in response to that data deterioration. Our view is that because of the sticky US inflation, the Fed will pause potentially after May, but then keep rates at very high levels for the remainder of the year, meaning that if that then forces the markets to readjust those expectations, the safe haven dollar will be also the high-yielding safe haven dollar again, and essentially both components of the dollar smile, if you wish, could allow the dollar to regain some ground, especially against risk-correlated, potentially even the commodity currencies out there.
What about against the euro? Because I think the markets had this view that the ECB was later in than the Fed and will be later out than the Fed. So that argued for owning euro against dollar.
Yeah, I think there is certain divergence that's being priced in at the moment in the markets, as in the dollar, as in the Fed is expected to cut rates, where the ECB expected to continue with the hikes. As a matter of fact, there was only one occasion in the last really more than 20 years, really, since 2000, where the ECB hiked rates while the Fed was actually cutting rates. That was the infamous July 2008 hike, 2 months before the Lehman disaster. The point being that our view is that yes, the ECB could continue hiking rates, potentially pushing them to as high as 375, but at the same time, we strongly doubt that the Fed will be cutting rates. So as a result, I think that from a rate differential point of view, from a central bank relative policy outlook, I think that there's certain downside risk for euro dollar from here. Our target is 107 for the quarter end, but it is also the case that if risk aversion were to rear its ugly head at some point, maybe sell in there and go away, euro could be lower still. Yeah.
What about sterling? It's risen to its highest level in, I think, about 10 months versus the US dollar. To what extent is that trade driven by resilience or increased optimism about the resilience of the UK economy versus weakness in the US dollar side of that trade?
It's a little bit of both, as in on the domestic side. Certainly the data hasn't been as bad as expected. I mean, as you probably remember, back in November, the BOE shocked most people by essentially declaring there'll be 18 months worth of recession ahead. None of that has been confirmed. Thankfully, the cost of living crisis is proving to be less negative than feared. Clearly, there is some improvement in terms of trade for the UK because of the lower gas prices, energy prices, and so on. The thing is, however, that the outlook is still not that great, even in relative terms. It certainly helps the fact that in comparison, other economies like the US have seen their outlook deteriorating quite rapidly, so that is helping the pound. But I wouldn't think that the pound is a strong conviction buy purely on the basis of domestic fundamentals. I should also mention that if you look at the last 6 US recessions going back to 1980, actually with a remarkable consistency, the pound was among the worst performing currencies in the initial stages of those recessions. So I think at current levels, certainly remarkable performance, certainly going a bit against our own forecast, but I wouldn't think that it will extend a sustainable uptrend from here. I would rather sell cable here. Euro sterling seems a bit more fairly priced, but again, here it's really about to what extent the European outlook, continental Europe, could deteriorate to sort of reconverge back to the low benchmark that the UK case still is. Yeah.